Amid global tensions and volatility, investors are moving their portfolios to cash. You came here for the truth, so let me unveil that for you. Today, we will talk about this issue as well as showing you a whole bunch of different charts. Let's begin with this article. Stocks rallied around the world while the dollar fell amid speculation the Federal Reserve will stick to a gradual tightening of monetary policy. What they actually said here, it's pretty funny. I always like to bring out some comedy when I can. That the Federal Reserve will raise interest rates in December, and that after that, they may not raise them anymore. It's a joke. How many times do we have to hear the boy cry wolf? We will not know what happens until it happens. All the speculation, all the talk, forward guidance, and all this other silliness that we hear from the Fed means nothing until they actually take action. We could, in fact, see it. I'm not saying that we won't see a rate increase. However, we have to really take it with a grain of salt because we've heard it so many times before, and I'm sick and tired of it. The greenback extended its retreat from a 7-month high as data showed consumer prices, this is pure BS, excluding food and fuel, rose less than forecast. Well, why don't you include the food and fuel prices, of course, because they're quote unquote too volatile, meaning they rise faster than the other things you add in there. Really silly. Anyway, moving on to this. Fears of a bond market crash, a breakdown in globalization, a new crisis in the Eurozone. There were a bevy of reasons for fund managers to push their cash balances to 5.8%. And in fact, it hasn't been this high since 2001, shortly after 9/11. Think about that. People are very concerned. They want to move to safety. Now they're choosing cash, which I don't necessarily agree with, to have a large percentage of the portfolio in that. However, that's what they did for that reason. And then ultimately, what we have seen here is the same thing occurring yet again. This has happened multiple times before where it's been, spikes, and we'll show you that in a second here. This here is the chart form of what I just talked about. At the left side of the chart, we can see 9/11, where people have moved to a significantly high percentage of cash. And then today, where we see nearly hitting that same level. In the middle, we see Lehman Brothers. So think about this as the catalyst to the financial crisis. We've already exceeded that amount in today, right now, in this indicator. That's, very interesting to say the least. We are 15 years, going back 15 years at this time, the amount of cash, and you think about that for a second, that is quite high. At the same time, you look at the Lehman Brothers situation and have to figure people are worried at this time. There is definite risk and fragility in the markets. Where there is fragility, there will be a crash. This right here, what do you consider the biggest tail risk? And they wanted to highlight here, crash in the bond market / rising credit spreads. A very serious situation. And above that, we see EU disintegration. Another very, very important thing. I believe that the dominoes are falling as it is. Everyone's asking, and you'll see them in the comments, when will it all crash? But just look at the Eurozone. Look at the images. If you go there, you'll see some things for yourself. I've seen those things. How you see that disintegration. And there are other things in here as well. I want to move on though. Fed wagers. Stocks rise, dollar falls amid bets on gradual tightening. Just what I was talking about before. And you can see that, the dollar falls oftentimes nowadays, for the absolute wrong reasons. They're going to tighten on interest rates, and that makes the dollar fall. Yet when they print money, it makes it rise. Things don't even make sense anymore. The Bank of Japan fights the tide. Now, the Bank of Japan is responsible for the biggest disaster I've ever seen a central bank do, and that is decide to print as much money as it takes. Here we have foreign selling outpaces Bank of Japan's ETF purchases. The Bank of Japan is the only one buying anything. And look at this chart here, basically showing you that the foreign money is pulling out, Bank of Japan is stepping in, but they can't even buy it fast enough. That's how fast money is pulling out of Japan at this time. And when you say how well QE works, yeah, and then you point to Japan as the prime example, the shining star, I guess we don't see eye to eye on that. Foreign exodus, Japanese equities on track for the biggest annual outflow since 1987. 1987, a huge year, not only in a global sense, but for Japan as well. And that, my friends, is very, very frightening. If you found this video informative, please give me a thumbs up. Last but not least, if you found the video informative, I know you'll find my book, The Money GPS, even more informative. Head over to Amazon. They have this look inside feature. It's going to allow you to actually flip through the pages of the book and see if you like it. Take care.